Hi, everybody. Welcome to this next module on investing and the markets. Our primary focus during this session is going to be just looking at thoughts around equity investments or stocks, bond investments, which are often referred to as fixed income, as well as mutual funds, right? So we're pooling money together. It is a little bit on the longer slide, and you may notice that what I'm getting ready to go through might look a little bit different than what's been uploaded. I just removed a couple of slides that I thought were just either redundant or didn't quite provide any value. So I will be trying to go through this. I'm going to probably just skim over a few slides. I won't necessarily go into depth on all slides because, again, some are pretty self-explanatory, don't really require any really additional commentary. So again, as you go through this lesson, if you do have questions, make sure you're emailing me. Okay, so we're gonna start with stocks with equity ownership, and the first thing is we want to make sure we understand that when you are buying and selling a stock, you are going through an exchange, right? So it's kind of like going to a place where everyone has their other stocks, and you are buying and selling at that community. Okay, and a lot of stocks are traded on the New York Stock Exchange, but that's just one of various exchanges. As you can see here, it is part of the Intercontinental Exchange, which comprises 11 different exchanges. So there used to be the American Stock Exchange, there used to be the New York Stock Exchange. There's now the NASDAQ that is also an exchange. So there's different exchanges out there. And it's not necessarily important that you have to memorize all of those, but I just need you to know that you do go through an exchange in order for that transaction to take place. Our current stock exchanges are usually open from 9:30 to 4 p.m. Eastern time. So obviously, if you're in Central, it would be 8:30 to 3. Okay. If you're in Pacific, it's like 6:30 to 1. Okay. So it can be, depending on where you live, these are based on Eastern time zones. Okay, so how do you go about purchasing and selling stocks? Well, you first need to have an account, and the stock needs to then be in the account. Or, and this is rare in this day and age, is to actually have a stock certificate, which is actually a piece of paper that will say this, stock of IBM is worth, 100 shares. Okay, so you could have a certificate. It's kind of like a title on a car. Anyway, so you have the certificate, or that certificate is called in book entry, and it would be inside of your account. And then you need to have some entity that is going to help make that transaction occur. So you can do it either through a broker. This is going to be one person where you ask them to buy and sell for you on your behalf. And their job, obviously, will be as a broker, is going to collect a commission on that transaction. Okay. And the broker then can be divided into two different types of categories. One is a full service broker, and another is maybe an online or a discount broker. So, a full service broker is going to give you a ton of different features, right? So they might provide you advice to say, hey, you know what? Maybe that stock is not what you want. Maybe you should look at this one instead. Or, hey, what if we were able to provide, I'm trying to think of what else they might provide, advice. That's obviously probably the most significant one from a broker standpoint, versus an online broker that is really going to be less expensive, and they are going to just do exactly what you want them to do. Okay, so you have to be in control on this do-it-yourself platform, right, or that discount broker. Okay, so when you are going to place an order, you need to have the name of the stock, and that is typically done through a ticker. Every publicly traded security has a ticker or a CUSIP, right? So it identifies that specific company. So, for example, you see that Apple, its ticker is AAPL. And in most cases, the ticker tries to be a representation of the company, right? So before Meta changed their name, it used to be Facebook. Okay, so it would make sense that the ticker FB applies to Facebook. Okay, but that's not always the case. Once you then know what ticker you want to sell, then you need to determine, or I should say, what you want to do with a company. Then you need to determine, obviously, are we buying or selling, and how many shares we're going to buy. Um, back in the day, probably 20 years ago, it was very challenging to not buy round lot of shares. And a round lot is in multiples of 100. So if you called your broker, typically you would want to buy 100 shares of this or 200 shares of this or whatever the case may be. Well, now because of the technology growth in technology and the ability for companies to be able to slice shares, right, and account for those fractional shares at a much more easy and convenient way, we can actually now do fractional shares. So now you can actually call in your broker and say, I want to buy, instead of 100 shares, I want to buy $500 of a specific stock, and you might get 12.3582 shares. These fractional shares are available now, again, because of the ability that technology has allowed the accounting of even fractional shares. Of course, this is now holds true for things like Bitcoin, right? If most people don't have the capacity to go about buy one coin, at whatever it is, 60 something $1,000. And so you might spend $1,000 and own 0.0006 point coins. Okay. So again, breaking it up into smaller slivers. There is the ability also to buy stock on what is referred to as margin. And this is just where we borrow a portion of the cost to purchase stock. So your broker basically says, hey, we're going to give you a line of credit, and you can buy stocks on that line of credit. Okay. Now, with that comes an expense, right? So you have to pay interest on this money that you borrow from the broker. However, if you have less money involved in the transaction, then you have what's referred to as leverage, right? So let's say I put in $100, but I'm able to borrow $100 from my broker. Now I have $200 to buy the stock. Well, if the stock goes up, let's say from $200 to $220, now I have a 200, or I should say a 20% return, and I'm only spending $100 of my money. Okay, so I borrowed money to be able to engage in that transaction. So that's what margin transactions are. One thing that is really unique about the stock market as a whole is that it's one of the only places, I'm not saying it's the only, but it's one of the only places that you can sell something that you do not own. And that is referred to as short selling. When you are short, you are selling something that you have borrowed. Okay. Borrowed and then sell. Okay. So obviously, if you own something, you're just going to sell it. Okay. But in short selling, I think the price of IBM is going to go down. So what I'm going to do is I'm going to borrow the stock. Okay. I borrowed the stock and I'm going to sell it. Now I have to replace that stock. But the reality is I don't have to replace it at the price that I borrowed it at. I just have to replace the stock itself. So if I borrowed it and it was $100 a share and it goes down to $90 a share, I borrowed it and sold it, and the stock price goes down. Now I can buy it back at 90 and replace it. And so I just made $10, right? Because I sold it before I actually bought it. And that's what's unique about stocks is you don't actually have to own something to buy it. We don't normally go into a car dealership and say, hey, I have a car that I would like to sell you. You typically have to bring them the car. Well, let's say you bring them the car, but it's not yours. Well, it'd be very hard to try to sell that car and then go out and be able to buy a replacement car to replace the person you borrowed it from. But in stocks, we can do that. Okay, so now you're wondering, okay, now I want to know, how do I then go about in determining whether I want to buy or sell a stock? Well, we can do two different types of analysis. One is we can do technical analysis, which is where we're looking at price patterns. Okay, so we're looking at price patterns based on price and volume. Those are the two main critical features that technical analysts look at when they're trying to make a decision. Okay, what is the current price and what's the volume that is driving those price changes? On the other side, we have fundamental analysis, which is where an individual, an analyst, will actually start to look at the company as a whole and assess, is this company a good value? Okay, and I'm going to look at things like its revenue, I'm going to look at its debt, its balance sheet, its ability to make money, its competitive industry that it's in, and I'm going to also look at the economic factors that apply to that specific company. Okay, so two different ways to look at how to determine what I might want to buy. You might use a technical approach or you might use a fundamental approach. When we're analyzing stocks from a fundamental perspective, one of the things that we have to look at is what is going on within the economy that stock is engaged in, right? Because the economy will control or at least significantly impact the outcomes that the company is able to engage in. So one of the things that we want to look at is the gross domestic product of an economy, and this is basically the total market value of all the products and services produced in a country. Excuse me. So we would like to look at what's going on. What is the country producing, right? And as the production of that country is growing, then the companies within that country are probably also growing as well. We want to look at fiscal policy. This is the policy. So the government controls fiscal policy and monetary policy. Okay, so we're focused right now on fiscal policy. This is about taxes. Okay, this is about how the government spends its money. If the government is trying to grow the economy, the government could come in and start to really put money into infrastructure, for example. And I don't know where you all live, but where I live, it seems like in the last year and a half, every road seems to be under construction. Well, this money coming from governments, contractors to expand roads, is going to pay all these workers to do that work, and then that is going to funnel money into the economy. If they want, and then of course, if they want to also expand on that, they could reduce the taxes that people have to pay, which also then makes them spend more money. But they obviously have to be careful with that because the more that they do that, obviously the more inflation will rise. More dollars chasing the same amount of goods. Okay, we also want to look at other countries as well. We want to see what's going on internationally, right? As of right now, we have multiple different global conflicts going on. Well, that can drastically impact the economics, not only of the country that's involved in those, but also in companies that are engaged with those countries. So we want to be mindful of that. We want to make sure we understand interest rates and the way interest rates can impact the economics of stocks. Okay. So first of all, we need to make sure that interest rates are typically going to be set by the Fed. The Fed determines the short-term borrowing rates. Okay. And that then determines the ability of companies to borrow. As rates rise, which is what they've done over the last few years, the rates have been increasing. That makes it harder to borrow, not harder to borrow, but more costly to borrow for companies. And as companies find it more costly to borrow, they may not be able to engage in as many activities that are going to produce greater returns for their shareholders. And so we want to make sure that we understand that interest rates have a very significant impact, obviously, on stocks. Okay. There are some stocks, though, that are going to be more interest rate sensitive than others. So, for example, Walmart. As interest rates rise or fall, Walmart is probably going to continue to do okay because people still need to buy groceries and main household goods and items. Whereas Coach, for example, as interest rates rise, people's credit card balances, or not balances, but their interest rates may rise, and they may not want to go and spend $3,000 on a purse because if they put that on their credit card, it would cost them a lot more money. And as I mentioned, the Federal Reserve is the one that helps to establish the policy, and their control of interest rates as well as their monetary policy is important. So the Fed, the Federal Reserve, can increase the money supply by selling securities. Okay, so I have a security, the Fed has a security, I'm going to sell it to you. I'm sorry, buying securities. They're going to buy securities from banks. So the money is going from the Federal Reserve to the banks, and they're receiving this security. Or they want to take money out of the economy and they will sell securities. So the banks get the security, The Fed gets the cash. Well, the cash moving out of the banks is going to impact their ability to loan money. Okay, and that means that the bank's ability to loan money, that money to be loaned is going to shrink, which means that there is less supply, which means the price of that money will go up. Because if you think about interest rate, it's nothing more than the cost of money. Okay, so another thing that the Fed obviously is required to consider is the inflation rate. And we have seen and heard over the news that inflation has continued to creep up. Okay, and inflation is nothing more than the rise of prices of a basket of goods, and it's typically tracked by the consumer price index. So the consumer price index was a basket of goods that was established to say, okay, we're going to track these items, and we're going to watch how much they grow in value or in cost over time. Okay. Another way to measure inflation is the producer price index. And this is what companies have to then use to pay for their goods and services. So, what do they have to do? They have to run their manufacturing facilities. That might require coal. They have to build homes and such. They have to require lumber, metals. Okay, so these commodities are what's driving potentially that producer price index higher. Okay, so why then do we even consider stocks? Well, they typically will have an outperformance. If you think about what a stock is, it's an ownership interest in a company, and that company is there to generate a return and maximize the wealth of the shareholders. And so that's what they're trying to do. And so when you own a company, you are owning an interest in that company's cash flows and ultimately its profits. Okay, and then as we see here, portfolio return. Since most of the return of our portfolio will come from stock investments, you obviously should be a investor in stocks. Most people will invest both in stocks and bonds. Now let's segue into bonds. Hold on one second. Let me just take a quick drink here. Sorry, I had this like a tickle kind of in the back of my throat. Okay. All right. So what is a bond? Well, a bond is really nothing more than an IOU or IOU. Okay. It's an IOU. I'm going to give you money. And while you have my money, you're going to pay me over a specific period of time a small amount of a cost. I'm going to charge you for that. That's called interest. And then at the end of the time that we've decided that you're going to borrow this money, you're going to pay it back. Okay, that's an IOU. So if I'm a company and I borrow money, if I issue a bond, I'm going to the bondholders and I'm giving them a piece of paper, and that piece of paper says, "I owe you 5%, and I'm going to pay you that every year, and then in 5 years, I'm going to pay you back what you paid me." That's it. That's really what a bond is. Okay, so they're debt securities that are issued by governments and corporations. Okay, and they are used primarily for fixed income. I shouldn't say it was fixed specifically income. Okay, because why would I give you $1,000? Well, you're going to pay me during this 5 years an amount of money that's going to be compensating me for you using my money. Okay, a couple of things that we need to know when we're talking about bonds is the par value. This is the value of the bond that is going to be paid at maturity. And almost always it is $1,000. Okay, not every time, but most always it is $1,000. It's important to note, though, that this does not mean the purchase price. Those do not mean the same thing. Par value is what you receive at the end of the time when it matures. Okay, it's going to be at the end. Okay, the coupon is going to be the percentage of par value that is paid out as interest. In most cases, it is paid out semi-annually, but not always. It could be on an annual basis. Let's say you have a bond that is going to pay 5%, then the coupon rate is 5%. Okay. And then the maturity is just when it comes due. Let's say it comes due December 31st of 2034. Okay, so we have a 10-year bond. All right, interest payments. So when it comes to bonds, issuers are required to make interest payments. Okay, and I'm gonna take this out. Required is depending on the type of bond that may or may not require. Okay, uh, but in this example, let's just assume that they are. So you have a bond of $1,000. Remember, par value that's what's going to be returned to you at the end of the bond, and it's going to pay 6%. We want to calculate the annual interest payment. Well, we just take the 6%, multiply the par value, and we know that we're going to receive $60 every year. $60 every year. Okay. If this pays semi-annually, then we're just going to cut that in half, and it would be $30 every 6 months. Pretty straightforward. All right. So how do we determine the rate of return on our investment? Well, there are two components to most every investment. There is the capital gain or loss. Okay. And what that means is the asset that you have, you bought it, and then you're going to sell it. And you're going to either sell it at a price higher, at, or below what you sold it at. And there may be a return that you receive because you sold it higher than what you paid for it. You may actually have a negative return in which you sold it for for a lower price than what you paid for it. And you may sell it for exactly what you paid for. Okay, so there could be a capital gain or loss. The second component is going to be the income. Okay, so we also have the income component. And the previous example here, we had $60 a year. Okay, that's going to be part of that income. Okay, but we may decide to sell the bond before it matures, which means we may have to have a capital gain as well. All right, so when we have a rate of return, this is going to focus on the capital side. Okay, we're focused on the capital side. And we can do that by using this formula right here. This is going to be our holding period return. We're going to take our ending value minus our beginning value, okay? And we're going to divide by our beginning value. Now, if we want to include this piece, we can do that. We can take our ending value minus our beginning value plus any income we received and divide by our beginning period, okay? So this just gives you an example right here. What would be the return if we sold an investment for 1,000, we bought it for 1,000, and we have a coupon. The capital return is going to be 0, right? Because we didn't make any money when we bought or sold it. Okay, but we still have the coupon payment, which will provide us a return. Okay, so we would do something like the ending value minus the beginning value plus our income over our beginning value. Okay, so we still have that. Okay, this would be $100. Sorry, which would be 10%. Okay, so 100 over 1,000, 10%. All right. So what happens though if the bond, right? So we have this bond is at a price below par value. Okay. So remember, we're going to receive $1,000 at the end of the term. But let's say you bought this bond at $900. Okay, what's going to happen to the bond is over time, it is going to slowly start working its way up to where at maturity, so this is maturity, it is going to then pay you $1,000. Okay, so we should expect that the price of this bond is going to pay us more than the coupon rate. Okay, and that is actually true. Okay, so in this case, we're using our 1,000 minus 900, which is $100. Remember, ending minus beginning over beginning. So the ending value is going to be 1,000 minus our 900 is going to be over our 900. And that's going to be 11%. Remember, this is the beginning value. This is what we paid for it. Okay. So we're going to have a capital gain on this bond of 11%, and we're going to receive still our 10% coupon rate. Okay. So pretty important. Now, keep in mind, this is not the yield to maturity. That is a different set of circumstances, and we're not going to deal with that right now. We're just trying to look at what is going to be the different aspects of our return. Okay, so above par, let me go back to this right here. So this is our $1,000. And let's say we buy the stock up here at 1,100. Okay. And what's going to happen is over time, this bond is going to come down to pay $1,000. Okay. So in this case, we have our return of negative 9%. Okay. So the capital gain of this is we're going to actually lose 9%, but we are still going to gain 10% from the coupon. This never changes. We will always receive 10% or the coupon rate of the maturity value or the par value of the bond. So it doesn't matter what the bond fluctuates at, we will always receive that. Okay. All right, I'm going to leave this one alone. I'll let you read the example. So what are the different types of bonds? Well, we have treasury bonds. Treasury bonds are issued by the U.S. Treasury. And these are covered by the full faith and credit of the U.S. government. Okay, so how can the United States issue bonds? Well, they collect taxes, right? That's their revenue source, and that revenue source then will pay that interest on the bonds that they issue. Okay, when you have a treasury bond, you need to make sure that you understand that is you will pay federal income tax on it, but you typically will not pay state and local. So it typically is exempt from state and local taxes. Okay. And we'll look at municipal bonds here in just a minute. All right, corporate bonds. A corporation can use their revenue as a backing to be able to pay off their debt. So they can actually issue bonds as well. Okay. Now, the government has taxing authority. Corporate bonds don't have the taxing authority. They must be able to sell their bonds and be able to pay for the interest. So there is what's referred to as default risk. The federal government can raise taxes so much that they will not actually default on their debt obligations. Okay. But corporations can, and that can be a problem. And so because of this default risk, we will want to receive a higher premium or a higher return. Why? Well, because now we have this risk that wasn't in the treasury bonds. There are typically, we're going to look at this in just a moment on the slides, but there are what's referred to as high or investment grade bonds, and there's high yield bonds. Okay, investment grade bonds are going to be those that are quality bonds where it's very unlikely that they're going to miss their payments. Junk bonds, or also high yield bonds, are much more riskier bonds. They're typically issued by smaller corporations, and they have a higher degree. There is a higher degree of this risk that we just talked about. Okay, and because there is a higher degree of that risk, the expected return is also higher. Muni bonds. Okay, muni bonds are issued by state and local governments. Okay, what this is unique is that muni bonds are actually exempt from federal income tax and the state income tax in which you live. So if I live in Indiana, if I buy an Indiana bond, let's say my city, Noblesville, issues a bond and I buy a part of that bond, I won't pay federal tax on it, which is good, and I won't pay Indiana income tax on that. So that's also good. Okay, so that is pretty cool. Now, it's important to make sure that when you understand there is a tax feature of these municipal bonds, we need to be able to figure out how can I compare municipal bonds to corporate bonds to see which one I should get. And that's where we can find our tax equivalent yield. Okay, so the way we're going to do this is we're going to take our tax equivalent yield. Okay, and we're going to take we'll call it tax-free, and we're going to divide that by 1 minus the tax rate of the investor. Okay. So this is assuming that the investor is in a 35% tax rate. So basically what this would say is that the taxable or corporate bond must pay 5.38%, so that when you pay your taxes at a 35% tax rate, you end up with a 3.5% rate. Okay. Got it. Okay. So we have this is the tax equivalent rate. So Treasury is only paying 4%. So should we invest in the Treasury? Well, if we get 4%, but then we have to pay taxes on it at 35%, so we would take our return and we would multiply it by 1 minus the tax rate here, and that's going to give us a far less than 3.5%. Okay, so we know that the Treasury would have to yield us 3.58. This is going to be our Treasury as well. Okay, anything that is taxable, 5.38. If we're paying 35%, we would also need to receive at least 5.38 to beat a 3.5, or to be equal to a 3.5. Okay. Okay. So how do bonds change value? Okay. So interest rates are the most rising, or the most important interest rate impact. Okay. So I like it to try to show you an illustration here. So let's say you have a 5% fixed income bond. Okay. And we're going along, and all of a sudden interest rates drop. So a current investor, they drop to 4%. A current investor is looking at the market now that we're in a 4%, and they're saying, okay, I can get a 4% investment, but wait a minute, you have a 5% bond over here. Okay. So what's going to happen to this bond is it's going to rise in price because rates have dropped. It becomes more attractive to investors. I would like to receive a 5% coupon, not a 4% coupon, which means as the rates drop, the value of a fixed income will rise. So as we see here, falling interest rates. If interest rates fall, the value of your bond increases. Why is that? More demand. What about if rates rise? So I'm at my 5% and rates go up to 6%. Okay, people in the market now can get a 6% investment, and you're only at 5% coupon. Well, what's going to happen? You're going to have to put your bond at a discount. Okay, so rising interest rates. If interest rates rise, the value of your bond decreases. So there is an inverse relationship. Okay, there is an inverse relationship. But I need you to keep in mind, the amount of paid back to the bondholder at maturity doesn't change. You will still receive your par value. It's just that the current value of the bond will fluctuate. Okay. Now, as I mentioned earlier, that there's a required interest rate expense, that's not actually always the case. There are some bonds that are zero coupon. Well, what does that mean? They don't pay a coupon rate. So you remember when I said that the return is broken up into a capital return and an income return? Okay. With a zero coupon, there is no income. It is only going to be based on the capital appreciation. Now, why would anyone buy that? Well, because these are typically traded at a discount automatically. You buy them at a discount. Okay. And then it moves up to its mature value or its par value. Okay, so what are some of the tax implications? Again, as we talked about, there are two forms of return measures that a bond will provide. You are going to have a capital gain. Okay, if you buy or sell a price, if you buy, so I'm right down here. If you sell bonds at a price higher than what you paid for them, you may incur a capital gain. Okay, and this is going to be subject to taxation of your capital schedule based on how long you've held that asset. If you received income or interest, you are going to be taxed at ordinary income tax rates. Okay. So again, I'm going to give you this example. I'm going to let you look at it on your own, but it's basically an example of what happens if we sell bonds after specific time periods. Okay, so what are the risks that are investing in bonds? Obviously, they're paying you this stream of income, okay? But we've already talked about one, that's this idea of default risk. Every entity, with the exception of probably the federal government, which again, there is risk there. Don't get me wrong, there is risk, but for the most part, every entity besides the federal government has default risk. They could default. They may not be able to make enough money in which um, to pay their debt obligation. Okay. And part of that default risk is determined through investment agencies or rating agencies. Okay. So they actually will rate an individual issuer, and the issuer is the one selling the bond or trying to raise money, and they will determine how risky they are. Okay. So they will determine using these rating agencies. As that risk changes, all right, as it increases, you would expect a higher bond coupon payment or coupon rate. As risk is reduced, you would expect a lower risk premium. Okay, so this idea of risk premium is basically an add-on to a risk-free rate based on its risk profile. Okay, and here is the rating agency changes. So right here, I mentioned to you earlier, all of these are referred to as investment grade bonds. So a rating agency will look at an entity or look at a corporation or a municipality, and they will say, based on your tax revenues or your revenues, based on how much you're trying to issue, based on the economics of what's going on in the world right now, we will assess that you are a AAA rated bond, which means that is a very high quality bond, not the highest quality, but a very high quality bond. And they may say, okay, well, we can issue a bond at 4%. Whereas a highest quality might be able to issue a bond at 3.5%. Now remember, if you're a bond issuer, you have to pay this 4%. Okay. If you can increase your the financial stability, you might only have to pay 3.5%. So the better positioned you are as a bond issuer, the less you're going to have to pay for that bond. Okay. This band down here is referred to as high yield, or as you remember, junk. Okay. These are the types of positions, right? So this an entity that's trying to issue bonds that is a CCC or triple C might have to pay 12%. Why do they have to do that? Well, a rating agency has said, well, we really feel that you have too much debt already, or you're not making enough revenue, and we're really concerned that you won't be able to make your payments. Remember, why do people buy bonds? They want the income. They want to make sure that the revenue that's being produced is going to be able to pay for that interest payment. And then I also want to get my money back. That's also important. Okay. All right. So risk premiums, as I already talked about, risk rating and risk premium, the relationship between the risk rating and the risk premium is inversely proportional. That means that as the risk rating goes up, the risk goes down. As we go up, the risk goes down. Okay. As the risk rating goes down, the risk goes up. Okay, so we're just looking at that inverse related. The lower the bond quality, right? The lower this quality, the higher the risk premium. Why? More risk. The more risk I have, the more return I expect. Okay, the higher quality bond, the lower the risk premium. So the higher the quality bond, the lower the risk premium. Okay, what about bond maturity? So obviously bonds will be issued, and the company that's issuing these or the entity that issue them can select how long they want to have that bond outstanding. And you as the investor, you need to start to select, okay, if I want to hold this bond until it matures, is that going to provide me do I have the time to be able to do that? Okay, so I want to know when do I need the funds? If I need them in 5 years and I have a 30-year bond, well, I probably don't want to buy a 30-year bond. I might not want to buy a 30-year bond. I might want to buy just a 5-year bond because I may want that money right away. Okay. And then also the maturity of those can change how our money is being flowed into our portfolio, which should impact our balancing the portfolio or rebalancing. Okay, so maybe I'm looking at trying to receive income for a specific time, or maybe I don't want all of my money to be into one specific bond, right? That matures in 30 years. Maybe I want a bond that matures in 5 years, and then in 10 years, and then in 15 years. So I can create a laddered approach to helping the my portfolio be more balanced. Okay, specifically as it relates to interest rate changes. All right, so why do we consider bonds? Well, obviously they are interest rate sensitive, but they typically also are a safer investment because of the income component. Okay, so they are paying out a form of income, and that helps to offset its risk exposures. Again, they are sensitive to interest rates. As interest rates change, the bond values will change, but you will always end up with your par value if you hold until maturity. So always keep that in mind. And it provides a sense of balance to the portfolio. Okay, so you've got equity over here, you have ownership interest over here, and then you have a lending opportunity over here. That's what bonds are. As I just mentioned, we have ownership interests. Okay, so what are the ownership interests in your portfolio? Well, you might have real estate. You own real estate. And then you might also have stocks. Okay, when you buy a stock, you own a portion of that company and are entitled to a portion of its profits. Okay, I've already mentioned this again earlier. We have two components: capital gains or losses, as well as income. So we'll just kind of bypass that. The returns from investing, again, I've already looked at this. We have the ending minus the beginning over the beginning, which is typically your holding period return. All right, let's jump into mutual funds. This is where most of you probably will start. In fact, this is where most investors actually begin their investing career. So mutual funds, and here's a video link. So you'll have the PDF. You should be able to pull up this video to talk about just what mutual funds are in a very high level stance. But if you don't want to go watch that, basically mutual funds is where you have a company that's established. They attract a bunch of money, so it raises money from investors. Okay, this is a big pool of money, and then they go out and they buy numbers of stocks and bonds and other investments. And the reason it's called a mutual fund is because it's a fund that is mutually funded by a lot of different investors. Excuse me. And what happens is when you put money into this fund, you own or will receive a number of units. So let's say this brings in $1 million, and that $1 million then is purchasing a bunch of securities. And you put in, let's say, 500,000. Let's just use this illustration. And the company says, we're going to issue 1 million shares. You will have 500 units, or 1 million units. You'll have 500 units that your dollars is going to be attributed to that fund. Okay, so you basically own a percentage of your investment into the total value of that fund. So what are the main advantages? Well, the first is diversification. You may not be able to, on your own, buy all of these different companies, but inside a fund that is provided with a lot of capital from a lot of different individuals, you could buy a lot of different companies. And remember that diversification helps spread our risk out amongst different investments. You also can get professional management. These companies that are formed hire professional managers to manage those accounts. Okay, they're called portfolio managers. It can also help with minimal transaction costs, and it creates liquidity. Liquidity is nice because if you ever need to sell your shares, you're not selling the individual positions. You sell your shares back to the fund company, so they are obligated then to buy it back. All right, what are some of the disadvantages? Well, we have some costs that you have to be aware of. That's going to be provided through various loads. So they have to pay their money manager. They have a lot of administrative reporting that has to be done. So these can become expensive, okay, over the entire process of running the mutual fund. So you want to make sure you're balancing the cost with the expected return. Okay. All right. Mutual fundamentals, rising value. Those securities that are in that basket, As they rise in value, the fund shares also rise. Okay. The biggest challenge is this idea of capital gains distribution. So pay really close attention here. Shareholders receive capital gains distribution when the fund sells a security for more than it originally paid. Let's say this fund buys a bunch of NVIDIA stock. Okay. And this NVIDIA stock, it goes through the roof. And all of a sudden, they started out with $100 per share, and then they sold it at $800 per share. So there's a $700 gain. Okay. And they sell that. This $700 gain is then distributed equally amongst the investors. Okay. Which means you're going to pay tax. You're going to receive a 1099 dividend div that's going to show you have this level of dividend or capital gains distributions from your mutual fund. That can be very challenging if the fund as a whole is, say, down 3%. So let's say your fund is down 3%, but this gain right here helped it not be down more than that. Let's say it could have been down 10%, but this gain, this NVIDIA position really helped kind of hold it together, but it still had a gain. You still have this tax gain because it's on the individual positions. So you just have to be aware of that. Okay. Again, just a little bit of an overview. Mutual fund structures are typically set up as an entity, right? Either a trust or a corporation. They have shareholders that elect a board of directors. They hire a fund company or a manager to invest the money and to oversee the money. And then, of course, they work with different third parties to ensure that that mutual fund can be run appropriately. Okay. One of the biggest drawbacks is, as I previously mentioned, this idea of a load, which is just nothing more than an upfront fee. Okay. A load may or may not be charged depending on the share class that you are buying. There used to be three main types of share classes. Okay. So the first was a Class A share, which had a front end sales charge. So when you're buying this mutual fund, you might pay, say, 5% of the value. And what I mean by paying 5%, you're not really paying the value. You're just reducing the amount that you purchase by that 5%. So you're only buying 95% of what you would have bought. Okay. And that 5% goes to the fund company. Okay. Class B shares is a back-end load. Typically, what happened on Class B shares, and we don't see this very much anymore, these are kind of going away, is if you sold it in year one, you might have a 5% fee, a 4%, 3%, 2%, 1%, 1%. So we have a 1, 2, 3, 4, 5, 6 year back end fee. Okay, so if you sold in year 4, you would have a 2% fee. Okay, if you sold in year 6, you'd have a 1% fee. If you sold in year 7, then there would no be fee. There would be no fee. And then at the end of this, typically these convert to A shares. So 100% of your investment would get invested at right away. Okay. Class C shares charge a commission both when you buy and when you sell. This is a both, and there's typically going to be something like a low front and a low back end. Okay, so it might be 1% and 1% or something like that. All right, what do those fees pay for? Okay, well, first of all, we want to make sure that we understand what's happening. Okay, so there's first is down here at the bottom, there are marketing costs. This money manager, this company is trying to sell their investment expertise, and so they want to get that word out, and so there's going to be marketing costs. They might hire they not hire, but they might pay financial advisors to help them. They might run advertising on the TV or whatever it may be. Okay, and then of course they have an annual fee that's going to cover some of these costs. So there's an annual fee, a turnover fee, and an expense ratio fee. The expense ratio fee is basically the fee on its total assets. Okay, and in some cases, this can be extremely, extremely low. So, for example, the SPY, probably a bad example. You typically are going to find it anywhere from, say, 0.6 to maybe 1.25%. Okay, that'd be like the expense ratio. The turnover ratio measures the level of the fund's trading activity. Okay. This is how often they are turning over, buying and selling. So buying and selling frequency. Okay. And the reason that's important is because the more active management, the potentially the higher cost, because every transaction may require um, a commission to be paid. Okay, because whoever's engaging in that transaction probably is going to be having a commission added to that cost. Okay, so on generally speaking, your annual fee is going to be from 0.25 to 1% of the fund's assets. So again, this covers the managing of the fund and that sort of thing. Okay, and then of course marketing costs. All right, money markets. The money market is typically going to be short-term investments. Okay, short-term investments. That is where the money or cash equivalents market is created. Okay, and as you see here, look at this. This is what is typically involved in money markets: treasury bills, certificates of deposits, short-term investments, less than 30 days in duration, which means every 30 days or roughly every 30 days, those positions will mature and you'll receive your money. Okay, they are typically going to be low or no loads, and they have minimal expense ratios. Okay, so, but again, the returns are very low. All right. We could also have stock mutual funds. This is a set of funds that are going to focus on buying stocks. Okay. You could have growth oriented. You could have a balanced approach that has both growth and income. You could have a passive approach. You could have global funds. And you could also have themed based funds or thematic investing. Thematic. There we go. Thematic investing. Okay. So there's a lot of variety of ways that these funds could be built. Balance funds, again, they're trying to balance growth, income, stability, and typically are going to be targeting those that really are needing some form of income but still want some growth opportunities. We could also see life cycle funds. This is where you might put your money in a fund that's focused on, we'll call it 2050. All right, let's say you're planning on retiring in 2050. Okay, so you might buy the 2050 fund, and every year, so year one, year two, let's say this starts off at 78% equity and 22% bonds. Next year, it might be 77% equity and 23% bonds, and then it keeps going. Okay, so it's moving closer, conservative approach as you get closer to retirement. Okay, that's really what these approaches are looking at. Okay. All right. That wraps up the investments and market strategy. Again, as you go through these, feel free to email me if you have any questions. And hopefully they are helpful. We'll see you in the next lecture.